This is David Ranson, and this is our webcast at HCWE for December of 2021. We have a theme: old and new economic fallacies that cloud the macro landscape. The pandemic experience has been a tremendous economics lesson, uncovering many false assumptions about the way the economy works and the way its pieces fit together. In this webcast, I've linked some of the fallacies with which HCWE collided in 2020 and 2021, as commentators relied more on intuition than logic and evidence to wrongly anticipate how things would turn out. First myth is that the economy is inert. It needs to be pushed, pulled, or rescued by public policy. Perhaps the biggest economic surprise of the pandemic episode was how quickly recovery came. Initially, international agencies such as the IMF and OECD were united in forecasting a long-lasting depression, and this became the standard consensus view in the financial industries. Natural resilience, not part of their thinking, would have been a more sound basis for assessing the outlook. As Exhibit 1 shows, the GDP recovery resembled the stock market's extraordinary rebound, although it was not quite as immediate. It's a classic picture in which recovery is fastest at the bottom, slowing systematically as it approaches completion. This is no different from the way any natural system returns to equilibrium after it has been disturbed. Common sense should have suggested that there was no reason for a prolonged downturn. Natural disasters take lives and some destroy capital, but they do not deprive survivors of either the will or the opportunity to restore the economy. The COVID pandemic has destroyed very little capital, whether physical, financial, or human. There were good reasons for the economy to change its shape or product mix, but not ultimately its size. So, as in Exhibit 2, the economy should have been expected to pick up pretty much where it left off. This was the picture published in an HCWE report back in March 2020. The second myth is that the impetus behind the pandemic recovery has been massive fiscal relief. Again, the conventional view put little faith in natural resilience. It asserts that we owe the economy's rebound to extreme fiscal policy, and even that it could not have been achieved otherwise. In that case, countries whose fiscal policies were most extreme should have had the most impressive rebounds. On this point, the pandemic experience has provided very strong international evidence. Actually, the strongest rebounds occurred where the prior setback was deepest, as shown in Exhibit 3. Economic rebounds occurred everywhere in the developed world in the second half of 2020. Least Square's analysis shows that fiscal initiatives did not contribute to these recoveries. Exhibit 4 illustrates these calculations by classifying the G20 countries in two ways. First, according to whether the scale of their extraordinary fiscal policies was above or below average, and second, according to whether the preceding GDP setback was deeper or less deep than average. The result shows that rebounds tended to be stronger where fiscal policy was less generous. When the same test was applied to business loan and guarantee programs, the outcome was the same. Myth number 3 is that complete recovery would be marked by the restoration of full employment. It's traditional to assume that national output is held back by unemployment. GDP is said to reach a level called potential GDP when full employment is restored. But this thinking misses the fact that the labour force is very far from homogeneous. Its most essential members are highly productive, motivated, and the first to be rehired in a crisis. At the other end of the distribution, those who are rehired last tend to be those who are more choosy in seeking work and who add much less to the collective output. The employment of labour is a classic case of diminishing returns. As depicted in the left panel of Exhibit 5, the relationship between total output and labour input is a curve. As output returns from a crisis, moving from left to right, it approaches its maximum long before the labour force is fully re-employed. Financial capital is different, homogeneous, as described in the right panel, and it relates to GDP in a straight line fashion. GDP cannot grow further once all available financial capital is deployed. The next misconception is that printing money boosts growth. An extreme expansion of the monetary base, popularly known as QE, is widely thought to boost economic growth, or even to prevent recession. This belief is based on faith rather than evidence, as there are no historical precedents for the large-scale experiments in newly created money that central banks have been conducting since 2008. What history can tell us derives from past occasions in which the monetary base changed on a much smaller scale. That evidence is illustrated for the United States in the form of a bar chart in Exhibit 6. These data show that increases in the monetary base historically were associated with slower and not faster growth. The longer-term correlation between increases in the monetary base and the economy's performance is also inverse. Exhibit 7 shows that decades in which bank reserves grew faster than average were decades in which stock market performance and real GDP growth were both weaker. Decades in which bank reserves grew more slowly were decades in which the stock market and the economy were stronger. The fifth fallacy is that growth in the money supply promotes inflation. By far the most popular explanation for inflation is too much money chasing too few goods. Although this adage correctly focuses on money as the locus of the inflation problem, it is only one of several theories. In hyperinflation, it's true that an enormous increase in the price level is accompanied by a similar increase in the volume of money in circulation. And this is interpreted as money causing prices. But in normal circumstances, this relationship disappears. The dominant relationship is an inverse one, as Exhibit 8 shows. When other measures of money, such as M1, M3, M4, are checked, their correlation with inflation is also negative. It is counterintuitive, but not difficult, to explain the observed correlation between money growth and inflation. As sketched out in Exhibit 9, a depreciation in the dollar is what leads not only to inflation, but to reduced economic growth. The demand for money, in turn, depends on the volume of transactions. With fewer transactions, households and businesses will be comfortable with smaller money balances. So there's an inverse relationship between inflation and M2 growth. Fallacy number 6, government, employment, and spending stimulate the economy. The assumption that government interventions enlarge the economy meets a conflict when applied to the labour market. An increase in government employment would ideally mean a reduction in unemployment, but in practice it implies an employment cut in the rest of the economy, as Exhibit 10 shows. This is a well-known phenomenon known as crowding out. Over a period of time, total employment actually falls after the government workforce expands. The private sector employment falls by more than the government workforce increases. A similar crowding out mechanism occurs with government spending, as with government employment. At any time, the economy's total spending is constrained, just as its total labour input is limited. Exhibit 11 shows that in years that federal spending grew substantially relative to GDP, growth in spending by the rest of the economy was lower. And those are the bars on the left-hand side. In years that Washington contracted relative to GDP, spending by the rest of the economy grew faster. And that's the right-hand bars. The crowding out response is split between an immediate effect, shown in the red bars, and a one-year delay, shown in the orange bars. But taking the evidence as a whole, crowding out has actually been a little more than dollar for dollar. The relationship between federal and total spending is slightly inverse. If you compare 1.7 with minus 1.6, that's the federal spending bars, a difference of 3.3, and then you compare that with the difference between 6.4 and 10.2, which is the full size of the private spending bars. The relationship between federal and total spending being slightly inverse, that's contrary to the widely advertised multiplier effect. Number 7, an increase in saving translates into capital spending and thereby higher future output. Ordinarily, saving is the result of households and businesses refraining from spending. Intentional saving harvests resources that enlarge the scope for producing and spending in the future. That's fine. But sometimes saving is not intentional. During the pandemic, for example, the left panel of Exhibit 12 shows several spikes in household saving that coincided with major fiscal relief initiatives in the US. In the right panel, it's clear that the fraction of the economy devoted to capital spending remained flat throughout the pandemic. Ups and downs in saving did not produce any corresponding movements on the investment side of the economy. Double-digit rates of growth in capital spending during the first half of 2021 created new expectations on Wall Street and elsewhere that the economy would continue to grow rapidly for some time to come. As Exhibit 13 shows, the growth in capital spending was parallel to that of the economy as a whole. It reflected the fact that all parts of the economy were participating together in the later stages of the pandemic rebound. That's the content of our webcast this month. Our next client webcast will be in February, and I look forward to speaking again with you then.